Imagine planning a family budget for the next 3 months. You know that money will come in, but you may not know exactly when. You also know that bills, repairs, and other expenses are coming. Companies face the same challenge, just with much larger numbers. Welcome to Star Treasury Insights, snack sized, the industry perspective. I am Sudeep Sharma, a certified treasury professional or a CTP and founder of Kuber Treasury Solutions LLC. Today we are answering an important question. Can artificial intelligence or AI help predict how much cash a company may need next quarter? Let's break it down using the STAR method: situation, task, action, and result. First, the situation. Imagine a healthcare company that treats patients throughout the year. The number of patients may rise or fall depending on the season. At the same time, the company receives payments from insurance companies, government programs, and patients. But those payments do not always arrive at the same time or same speed. One insurer may pay in 2 weeks, another may take 3 weeks, or much longer. A government payment may follow a different schedule. This makes it difficult for Treasury to know how much cash will be available over the next 3 months. At the end of each quarter, the company may need to make a difficult choice. Should it borrow money from credit line, or does it have enough extra cash to invest? So when the forecast is wrong, the company may borrow too much, borrow too late, or leave cash sitting unused. Now, next comes the task. A chief financial officer or CFO wants a more dependable 90-day cash forecast. A 90-day forecast looks ahead about 3 months. The company needs this information to plan hiring, equipment purchases, debt payments, and normal operating expenses. The existing spreadsheet process is not working well. There are too many different sources of information, too many manual updates, and too many changing assumptions. In some periods, the forecast may miss the actual cash need by a wide margin. The goal is not to predict every dollar perfectly. The goal is to give the leaders a more useful range of possible outcomes. Now, the action. The company introduces an AI supported cash forecasting system. First, the system brings together information from several places. This may include patient billing, money owed by insurance companies, bank balances, past payments, upcoming expenses, and information from the company's financial systems. Second, the AI studies past payment behavior. It may learn that one insurance company usually pays in 20 days, while another often takes 45 days. It may also notice that patient activity rises during certain times of the year. Third, the system looks for other patterns that may affect cash. These can include changes in patient volume, payer mix, seasonal demand, hiring, major purchases, and economic conditions. AI can analyze large amounts of historical and current information to identify patterns that may be difficult to see in a spreadsheet. Fourth, the forecast updates as new information arrives. For example, if insurance payments slow down this week, the forecast can adjust instead of waiting until the end of the month. This gives Treasury a rolling view of the next 90 days, rather than a forecast that becomes outdated soon after it is created. And finally, the result. A more current forecast can help the company see possible cash shortages earlier. That may give Treasury more time to decide whether to use the credit line, delay a purchase, move cash between accounts, or adjust an investment decision. It can also help the company avoid unnecessary borrowing when enough cash is expected to arrive. AI-supported tools may improve forecast accuracy and reduce the manual work required to collect and prepare data. However, the actual improvement will vary by company and should not be treated as guaranteed. Vendor claims depend heavily on data quality, system connections, business stability, and model design. The Treasury team still has an important role. People must review the forecast, explain unusual changes, test different scenarios, and decide whether the numbers make sense. Here is the industry perspective. AI can make forecasting faster and more useful, but it cannot remove uncertainty from the future. A sudden drop in patient volume, a delayed insurance payment, or an unexpected equipment purchase can still change the company's cash position. That is why treasuries should not rely on only one number. A stronger approach is to prepare an expected case, a better than expected case, and a worse than expected case. This helps leaders understand not only what may happen, but also what they should do if conditions change. The main lesson is simple. AI can help Treasury see the road ahead more clearly, but people still need to choose the direction. With reliable data, regular updates, and human oversight, quarterly cash planning can become less reactive and more thoughtful. This is Sudeep Sharma with Star Treasury Insights, snack sized, the industry perspective. One treasury topic explained in plain English in less than 10 minutes. Don't just improve, evolve.